Welcome back, everyone. Here we are with another video. This one is a very special one because we're going to put all the parts of the puzzle together so far from the beginning to this video. Okay, we were just talking about the different parts of the puzzle, but we didn't have the complete picture or what we were supposed to do. This one is a very special one because you're going to learn about any kind of strategies in the market that works. So it means that if you want to be a profitable trader, it doesn't matter. So what kind of strategy are you applying into the chart? Are you an indicator fan or are you, I don't know, if you're just looking for ICT stuff, I don't know, whatever you're just using, like smart money concept, you have to have these rules in order to be profitable. It doesn't matter what strategy you need to actually you have, and you need to just obey these rules. So let's go and dive into David Paul's speech. This is very short, like 20 seconds, but I have just written the rules for you. But listen to his speech.
There's three rules in trading. I like to fade the short-term trend in the direction of the long-term trend.
So he is fading the short-term trend in direction of the long-term trend. So these are the things that he's talking about that I'm going to show you how you're supposed to do it in the real chart. We're going to work on the schematic, and later I'm going to show you some examples on the chart, and you will see that how applicable and how feasible it is in the real market. So this is our first rule. So first of all, you need to have a long-term trend in the first rule, and also you have to have a short-term trend. Both of them should be trendy. Okay, this is one thing you have to keep in mind. Now let's go to the second one. This is putting entries where the masses put their stop loss.
My entries where the masses put their stops. And thirdly, that when I
So yeah, it means that where your entry is. Okay, I'm gonna show you on the market. And if you remember that we had a video about overbought and oversold area, we had different ways of finding our overbought, oversold areas using trend lines, using GANs, using valid pullbacks, and you can use different kinds of ways just in order to find your short, overbought or oversold areas. Okay, so it's up to you, whatever point of view is comfortable for your eyes and your personality. It is up to you. Some people use a market structure, some people use trend lines, some people use moving averages, some people use Bollinger Band or Bollinger Band or Keltner Band. It doesn't matter what strategy you're using to just find overbought or oversold area. As far as it makes sense for you and you have just trained your eyes to see them. So now let's go to the last one. I think this is the most important one. Up until you're learning the strategy, maybe this is nonsense or it doesn't make sense for you because this is the psychology that plays a very big role in here, that it is painful to add to the winners. And whenever you can add to the winners, you are now in the point of becoming a professional, or I can say super professional trader. Now look at the last one.
right, I want to add to winners. I want to be bigger when I'm right than I am when I'm wrong. And if there's one secret to making lots and lots and lots and lots of money in markets, is that you got to have the strength to add to your winners. Now,
So psychological strengths, okay, but you cannot add to the winners anytime you like. It should be in a way that it is aligned with the long-term trend, and it should be in a very actually in a specific point, which happens rarely in the market. So I'm going to show you why and when it happens.
people, in fact, don't do that. And in fact, most people, in fact, add to the losers.
This is the part that it can destroy your trading whenever you're just adding to the losers. I myself did it many times. I lost a lot of money, and even recently I have done this mistake. So, but to make up for these losses, you have to just try hard and just. It is something that it is not that it's that much easy to just use it in the market. They say that it is easier said than done. Now, enough about it. Now that we have these rules, okay, we have three rules. So how can we just use these rules and start to have a overall checklist for that? I have done it for you already. So now, as I said that, okay, first rule is that you have to have trend, short-term trend in direction of long-term trend. So it means that condition one is that you have to have, is there higher time frame pattern trendy? So you have to have a higher time frame, and that is trendy. Okay. So, and the second thing is that you have to have a short-term trend which is aligned with the higher time frame. But before we move in that one, so our higher time frame pattern should be strong. It means that it should have higher trend strength. Okay, so later our second condition is that we have to have short-term trend. So it is our trading time frame. So our higher time frame is our structured time frame. Our short-term time frame is our trading time frame. So, and is it aligned with our higher time frame? This is the very first rule you have to just obey in two conditions. And then the third one, when I'm right, I like to, sorry, the second one, put your entries where the masses put their stop loss. So it means that we have to put our stop entries in the overbought or oversold area in our trading time frame. It means that, so you have to just buy low or sell high, and at the end do vice versa. Okay, buy high, sorry, sell high and buy low. Buy high, sorry, buy low and sell high. Okay, so this is the condition all the time. But which high, okay, and which low? That's very important. Okay, so you cannot expect to just mess around with the time frames and you expect to get the high wins. And have very, very tiny stop loss. So unless you are going to have a low win rate, yeah, it is possible. Okay, but you have to just very cautious about which time frame swings or which time frames candles you are using. Okay, and the last one is that this is the secret. The guy, Dr. Paul said that. So if you are right, you have to add to the winners. Okay. Now here you can just make your own checklist. Okay, I have just tried to write this based on the checklist step by step. So is it a trend pattern? Trendy, I mean the higher time frame trendy. Do we have a strong trend condition two? And is our leg four actually here? If you're just looking Elliott waves, or if you're looking for the legs or scan legs, or it doesn't matter if you're using valid pullback legs, you can just count the legs. Okay, at the end of the leg four, okay, so which is aligned with leg five of the higher time frame. So this leg four belongs to lower time frame, but this leg five belongs to higher time frame. So because we're fading this, okay, now we are looking for in the here our middle time frame, or I can say trading time frame. So is the price in overbought zone or oversold zone? I call it overbought and oversold zone. Okay. So later on, if your price comes back to your overbought or oversold zone, so you need to have an entry signal candle scale. Or if you don't want to just use the candles as your entry signals, you can go to the lower time frame and find some swings that they are the same thing happens, but inside the candles. Okay, you're just trying to use some of the things that we have learned. So for example, in our bought or oversold zones, we have talked about FTRs, fail to returns, right? So, and when you're adjusting your reward to risk, you have to consider the time frame swings. Okay, you cannot put your stop far away, so, and you cannot expect to have targets hit. Okay, because each time frame has its own correction and impulses. Okay, it has its own nature of movement. Now let's go and look at the chart and see what happens on the chart when we are doing it. Let's go with the bullish scenario first. Okay, here we are. Now let's have a look at this one. Here we have a very higher time frame. So this red one is higher than our structured time frame. Okay, so let's just dive into the green one. So this green one is our trading time frame. Okay, and sorry, structured time frame, and this black one is our trading time frame. Okay, now focus on this last leg. Okay, now let's count them. 1, 2, 3, 4, 5. Okay, so can you take trades in number 3? Yes, you can. But is it as high probable as leg 5? No, because if you want to have a trend, okay, at least you need to have this ones. Wait a second. Yes, this lines. Let me take it aside. Sorry for this. Okay. So here we are. Now, if you want to have a high probability trading area, okay, you have to focus on the trend. So some people use trend lines like this. Okay. Now here, this is it. Okay. Now it means that this has a 1, 2, 3, 4. In order to have a trend, we need to have at least 4 points that they make trend line. Okay, based on the classic price action. So some people like this trend line. Some people like this kind of market structure. Okay, so some people like to use Fibonacci retracement and they put it like this. Okay, so this is 50%. Let me just use this one. Okay, it shows, yeah. So here, for example, some people use the 50%, or some people use the lower, retracement, deeper retracement. Okay, it's up to you, whatever you just like to just use. It is up to your preference and your point of view. Okay, so now that we have leg 5 here, so it doesn't matter if you find this leg 5 based on trend line, based on this valid pullback zones, or based on indicators, let's say. Okay, it is up to you. Now this is our leg 5 in the higher time frame. Now in our middle time frame, which is our trading time frame, which I have just plotted them in green. Okay, here look, 1, 2, 3, 4. Again, starting of the 5. So now in this one, we were in leg 5, and here again, if you want to have trend inside the trend, so remember David Paul said that I want to just fade short-term trend, and when it is aligned with long-term trend. So this is our red one is our long-term trend. This green one is our short-term also trend. So here, so you're looking for a place to get inside and fade in. Okay, so here, based on this leg, you're looking for the overbought and oversold. In this case, we're looking for oversold area. So we have one trend line, one channel, which is going up, another small channel, which is also going up, and we're looking for finding a place, so a zone actually to enter. Okay, so here you can use valid pullbacks, you can use FTRs, and so on. If you are interested in that ones, that you have to just go back to the course and find out, okay, what these things are. You have to learn this stuff. Okay, now here we can use this valid pullback zones, and you can just adjust your stop loss based on this time frame. Okay, so you cannot adjust your stop loss like this. Okay, because you're fading in this time frame. Okay, you have to hope for getting this one rather than this amount of reward and this amount of maximum risks. Okay, so you cannot expect to have your stop here and look for getting this one. Okay, because this time frame belongs to the red leg. The red one. Okay, this swings are higher time frames. Okay, it is less probable that we have this one. Is it possible that we can have this target? Yes, because it is in the trendy market and it is in upward trend. All the time frames are aligned. It is possible, but sometimes we have just corrections, and after taking our trades in break even or even a stop loss, it goes again into the higher time frame direction. But when you're just trading, you have to just know your expectation. You cannot just expect to have the high wins unless in this kind of scenarios you can have high wins, but not all the time it is happening. Imagine here. Now we're going to, this is let's say this is leg 1, leg 2, leg 3, and you're a little impatient and you want to just fade in this one. Okay, now here 1, 2, 3, 4, And whenever we have the end of 4, we're starting to beginning of 5. So now we want to have this stop here and get our target here, right? Now, if you're expecting to get down to here, look what happens before, yeah, it goes into your direction, I mean, your trade's direction. Later, before it reaches your target, it reverses back to the higher time frame, actually, direction, right? So you have to know where you're putting your trades, and you have to know what your expectation is, okay? And the adjustment of stop loss is one of the key criteria, okay? So let's say that you have entered here, right? Now you have this, let's say 2, okay, 1 to 2 expectation. So I think that sometimes even 1 to 2 is not easy to just get, okay? Here is the maximum range of this trend line, right? So if we just consider this one, look, if I play with the stop loss, it is 1.5. Now let me just make it a little shorter. What happens to stop loss? Okay, it gets half, but our target gets doubled, right? So if we get in a place that it is like we put our stop behind this one, okay, you will see that we have 1 to 4 in the same area, right? The same movement. So stop loss, where you put your stop loss plays a key role here. Now, when you're if you consider this one, okay, sometimes we have alignment of 3 time frames. If we have 3 time frames aligned, okay, it means that it is not only high probability, it is also very low risk area. It means that you can trail your target, okay, and or even your stop behind that, okay. But whenever we are in this area, although this is middle time frame and the lower time frame, they are aligned, but the higher time frame is not aligned with this direction. So you have to just know what expectation you have in mind before reaching any upcoming I mean swings or tension areas, or let's say like that. Okay, so now here, this was the actually bullish scenario, and this one is the bearish scenario. Okay, as I said, some people like these trend lines. Here, let me draw this one as well. So if this is our higher time frame, this is the lower time frame here. So the lower time frame trend lines are aligned with the higher time frame trend lines or channel. Okay, so now in this trend line, okay, we are looking for a selling high and buying low. Okay, so I mean that exiting the chart. Okay, so exiting the market. Now here we have to look for a way to just find our bought areas. Okay, if you go back to the playlist, you can find some ways of doing that. You can use it. You can use channel. You can use valid pullback. You can use I mean some indicators that they do that. Indicators work, yes, of course, if you understand what I mean the logic of market is. Okay, so it depends on your understanding. So what happens that if I enter here and it gets back and hits my stop loss? Okay, that's the key. You have to accept your stop loss. Okay, so 95% of traders are losing traders. Okay, because they cannot stop, they cannot accept their stops, or their stops are much bigger than their target. Okay, so or they're adding to the losers. They can let the or they cannot just let their target be I mean, their target reached. Okay, so that's the only thing that they're losing traders. Okay, now here, let me just go and show some examples on the chart. Okay, now here we are. Let me make it. Okay, so I'm getting rid of these pictures on the chart. Okay, now here and this one, just bear with me for a second. Okay, and this one. So, okay, here we have, okay, here we have a 1 hour chart. Okay, so sorry, this is, yes, 5 minutes chart. Okay, these red ones are based on this 1 hour chart. Okay, please look at this one. If you're looking for using mallet pullback to define your trend line, define your trend direction, okay? So here we have two of it. This one is the Philip zone, okay, here. Then we have, look, 1, 2, 3, 4, 5, okay? So here we have, this is the Philip zone, okay? So leg 1, leg 2, leg 3, leg 4, and beginning of leg 5, okay? So how strong is our trend? This is our a rule to just follow. That higher time frame pattern is just trendy. Yes, so far here, yes, it is trendy. Okay, so far it is trendy. Okay, so if you're looking, if you're just trading based on trend, trend lines. Okay, this is your trend line. So first touch, second touch, third one, and this is the range that your, the price is moving. Okay, this is the range that price is moving inside your trend line. Okay, so this is very important. Okay, so it changes a little bit, but it is almost, in average the same. Okay, now this is our trend line, higher time frame trend line. Okay, this is our valid pullback zone. Okay, now that we have defined our higher time frame, so what is the second one? We're looking for not only it must be strong, it must be trendy. In this scenario, we are talking about market cycle, right? So what is market cycle? Market cycle is market structure plus momentum. Okay, so here we have very weak channel. Okay, it is not a tight channel, it is not spiky, it is weak channel, and it is not here so far it is not a trading range, right? It is a very smooth trend, but not very strong trend. Okay, so now, okay, we're gonna dive into the lower time frame. Go there. So this one is 5 minutes. So how far time frames are apart? Okay, so you have to just be able to just find some trends whenever you're just changing one of the legs. Okay, so these are the legs in the higher time frame. Look, these ones are the legs in the higher time frame, right? This one, you cannot find any swings in this time frame, but you'll go down to a time frame which you can see this one leg like 2, 3, 4 swings. Okay, so like this one, you can see lots of swings that you cannot see in the higher time frame. This is very important. Okay, now when this kind of movement happens, like spiky movement, okay, now in this case you cannot see lots of movement ups and down, right? So it means that you cannot match 1 hour time frame with 5 minutes time frame, and you may need to go to 1 minute time frame. Look, this is 1 hour, this is 5 minutes. So you cannot, if you cannot find proper place to enter, okay, it doesn't give you any chance of pulling back and giving you some overbought or overbought area or like pullback. So you need to go to the lower time frame. So some people would say that, oh, 1 hour, 1 minute, it is impossible to trade. But it is based on momentum. Okay, the leg is very, very important. So this is our trend in the higher time frame. Now we're looking for 1, 2, 3, 4. The fifth one is here. Okay, here our fifth one. Now we're going to look for another valid pullback or trend lines here, right? So let's say, wait a second, please. Let's say this is our valid pullback. It is broken here, right? And this is valid pullback for 5 minutes, right? Now, this is our flip zone. Okay, now another one, this one, okay, here. Now, so it is so difficult to find a valid pullback there, but it is much easier to go for the 1 minute one and try to trade out of this one. Okay, now here that we have one movement, let me just show you the path like this. Just a second, please. Yeah, 1, 2, 3. We can start trading here. 4, end of 4. This is beginning of 5. This is end of 4, the place at end of pullback that we want to just fade in. Okay, so now if we look at this one here, now now we're looking for any reason to sell here. Some people use Fibonacci retracement. Okay, now it is coming down. Some people use this extension down, this drop down. 50% is, yeah, this is 50%. Okay, we have retracement up until like this one. Some people use this one. They say if there is no zone and if the price has not reached this zone, we don't have any trade. And also we can use some of this. Look, when it has momentum. Now let me use this one. Here we have our FTR, right? Let me make it, okay. This is our FTR zone. So FTR in 1 minute. Okay. Now, it didn't reach that one. Okay. Now, some people look for this one. Okay. This one here, this pullback. Okay. This drop base rally, which is responsible for, okay, this break. Okay. So here they do this one. Now, how do we enter the market? This one is one of the signals that you can use to enter a market. Okay. Or if you want to just get more confirmation, you can just break this time frame and go to the lower time frame and find another reversal actually pattern to get in. Okay. Now, the most important one is the last one. Okay. When you're trading, you have to just trade based on the swings that you are, okay, in, not based on this one. For example, if you just put a stop here and you're just targeting 1-to-1 at least, okay, it is beyond the swings. Okay. It is protected here. Yes, but it is too protected. But here itself is protected. Is it possible that we put our stop here and price comes and takes us out? Yes, of course. That is the risk that we're putting on the table, right? So is it possible that our stop gets hit multiple times? Yes, of course, it is possible. Yeah, there is no holy grades, but the holy grade is that accepting your losses, right? And as far as it is trendy, you can I mean, this time frame is aligned with the higher time frame, right? This time frame, I mean, 1 minute time frame is aligned with the, in this case, with 1 hour time frame. And if you were trading based off 15 seconds time frame and or 5 seconds time frame, which is aligned with this one, you get a trail up until the point that it is getting you out. Yeah. So you would put your stop here in the beginning. Yeah. So let's say this is your stop loss. Okay, yeah. So this is your stop loss. So whenever we're just creating, we're moving down. Okay, there. Okay, we're moving down. Okay, and making another pullback. So you trail your stop from there to here. Another one here. So another movement. It goes up and it breaks itself. Whenever it is breaking itself, you trail your stop loss here. And now another movement, yeah. So you could just trail it up until here. So, and if you are using trend lines, some people use trend lines. Okay, you could just get out on the other side of the trend line. But here, your stop would be hit in this area, right? So, but do we have this this time? I mean, this type of movement all the time? Yes. So, what is the key secret here? The key secret is that whenever you have this trailed your stop here and you don't have any risk on the table, you have to add in, right? You have to add in any position that is possible. Okay. So you can add in here. You can add in here as well. So you can add in here and you would be hit, right? Your stop loss is taken out, and Okay. And okay, let's say it is imaginary. I didn't think about that. But here it has 5%, it is 3%, it is 1 and 22, and this is 0%. So if you were just going to trade this one to one, it's up to you. It's does it happen all the time? No, it doesn't happen all the time. Sometimes, yes. So now, whenever you have your high time frame aligned with your lower time frame, and you know where to get in the overbought or oversold areas of your trading time frame, and then you put your stop based on your trading time frame rather than your high time frame, not based on the candle. Some people are trading, okay, this time frame, and they're putting their stop, I don't know, behind whatever, like this one, I don't know, okay. So it is for lower time frame swings, okay. So, and you cannot expect to get after you're just putting your stop here. I have seen many, I mean, YouTubers or other people that they just say that, okay, so get inside, I don't know, at places like that, put your stop behind uh, this candle and target other part of the swing. It is nonsense. Okay. What was the reason that we put our stop here behind this candle? The reason was not that it was the candle, it was the swing that was turning point. We consider this a kind of protected places. Can we put our stops behind, let's say, I don't know, this candle? Was it based on the candle? No. Your stop would be hit here, I think. Yeah. It didn't, but it could be, right? Now, I mean that it is not based on the candle unless you're just targeting candle size. Okay? I mean that you're getting candle scale size and you're getting exiting candle scale size as well. This is the way that we are using David Paul's system in our own system. So I hope this video was helpful for you. And I think this is the only video you need to just be profitable. Okay. Other than that, you have to just focus on your money management, and money management itself is painful. Okay. Why? Because it is so hard to accept stops, and it is so hard to be in the winning trade and don't touch your, position. Okay. So we cannot let go. Okay, as human being, it is in our nature. So we want to just control what is uncontrollable. If you're supposed to be, if you're supposed to lose in this market, if you're supposed to lose in this market to be successful, you have to know how to be a good loser. So there's a book by Tom Hogarth. He's a very professional trader. The title of the book is so interesting. It is. Um, I think the best losers are the winners, something like that. I mean, that it sums up everything which is related to trading. Okay. So if you just obey the rule, okay, if you accept the losses, and even with the, coin fillet, okay, you cannot become an unprofitable trader. So that's so much easy. It's a mental game, and it is a kind of number game. Okay, not just technical sides as just helping you to just have a little bit bigger edge. Okay. Now, thank you very much for your time. I hope this was helpful for you. So I think this just could help many traders. It is an overall idea that we used. Any trader that they want to be profitable, it doesn't matter if they're using trend lines or indicators or supply and demand, whatever strategy they're using, okay? They have to understand the logic of this, and they have to just put them be on the side that the higher time frame are supporting their logic and ideas. So stay tuned, have fun, see you in the next time.